Hi, it's Candace with SmartTrading. I'm back this week to give you some exciting insight on what it means to be a smart trader. Covered calls are one of the most popular entry-level type option stock combination strategies out there. It's usually how people get started in trading options in general, and certainly a combination of trading stocks and options. And while conventional covered calls can be profitable, data going back decades shows that the overall performance of conventional covered call strategies underperforms basic uncovered stock portfolios. Now granted, the market has been largely bullish over the last 2 decades, but still, there are inherent problems with conventional covered calls that prevent us smart traders from ever trading the strategy in any market condition. Even if the market conditions are more favorable towards that particular strategy. And you need to know why conventional covered call strategies are deficient and should be treated with extreme caution by traders. Most investors get into investing by purchasing stock in a company. That's their entry. They learn about a company and they like the company. They think that the company is going to do well. They put a little money into the company. Southern Company is a great long-term stock to consider. If you're a beginner, Southern Company is an electric company, and based on a lot of the demand that's going to be coming for electricity due to the AI boom that has only just started. So I really like this stock. Now there are advantages to just buying the stock as a long-term investment, no question about it. First is above average growth, if you pick the right stocks. If you pick the right stocks, you can put yourself in a position to achieve above average growth. For example, if you'd invested $10,000 in Southern Company in 2000, your $10,000 would have grown to $262,000 since January 1st, 2025. Over the last 25 years, your annual average rate of return would be almost 14%. That far exceeds the average return in the stock market. The total increase on that is 2,500% over the 25-year period. That is a great potential return. Second is the potential to achieve above average growth. And you just set it and forget it and collect the dividends. This requires no work. You are in the position, you don't have to do anything ever, and you can go about your daily life. And last but not least, with this particular stock and several other stocks that are out there, you have pretty decent dividends that are collected in addition to the appreciation of the underlying value of the stock. Now, this is a bit deceptive. Every time a dividend is released, they adjust the price of the stock by the amount of the dividend. And it usually makes it up and keeps going forward, but you're really not gaining extra. You're robbing Peter to pay Paul, so to speak. So dividends are a little bit overrated in my opinion. There are also some risks and drawbacks with just the buy and hold. For example, 100 shares of Southern Company requires about $8,300 in capital, because at the time of this report, it's trading at about $83 a share. If you have 100 shares and it goes bankrupt, you're looking at $8,300 in risk. Additionally, it can go into big equity swings, and those equity swings can be somewhat disturbing. Not only can they disturb your account, they can certainly disturb your peace of mind as well. For example, Southern Company was recently down 14% in just 2 months in 2024. That's a pretty big drop in Southern Company, and that's a pretty big drop in any account. The market was up here at about $94. And then it drops down here to below $81. And this happens in less than 2 months. You have very little upside potential, but at the same time, if the market moves down, you have all of the risk. So $150 potential gain in 1 month for a risk of $8,150. If the market goes up, this is your maximum profit in 1 month. And if the market goes down, this is your max loss in 1 month. It doesn't take a rocket scientist to figure out that it won't be long before you are looking at net losses, and you have to bring in this $150 quite a few times in order to make up for the market moving down, as it will often do from time to time. Nevertheless, if I can bring in $150 every month and do it 12 months a year, then I make $1,800 on the position. That brings my 22% gain on the risk. So there is some benefit to it, but this takes a very committed approach. This is why it is so much better if you have a covered call strategy that reduces the risk, increases the overall monthly income potential, and obviously explodes the annualized return. And that is the truth about trading. Don't forget to like and subscribe to continue seeing these insights. And if you want to learn more about the smart trading approach to covered calls, check out the link in the description.